Hi, this is Ed Hyman. So I'm so thrilled to be here with Jeffrey Gundlach. So Jeffrey, I've known you for many years, but I've gotten to know you better in the past few years, and we're doing it here on election day. Can you imagine that?
It's
So
almost like there
pretty
isn't an election
exciting.
day anymore. It's
Right,
election
it's the
season.
election month.
Yeah.
But Jeffrey, you're a great out-of-box thinker with an exceptional track record, and you've had a great business career, and now you've built a great business. Uh, so Jeffrey is also an avid art collector, which I can see behind you there, and
Yeah.
tying it together here. So Jeffrey's from Buffalo, and I find out that as we speak, he is in Buffalo, and so Jeffrey tells me that Buffalo has the best weather in the country,
In
3
July.
months a year.
In July.
and since Jeffrey has been coming back to Buffalo, he's endowed the art museum there, and much appreciated on that front. So with no further ado, I thought we'd get Jeffrey to set the table for us in whatever time you want,
All
on
right.
whatever topics you want to, and then I'll be listening, and then we'll get into a conversation after you've set the table. So Jeffrey, thanks again, and I look forward to hearing your thoughts. Table's yours.
All right. Thank you, Ed. We've been in an environment for multiple years, really better part of at least a decade up until 2020, when we had so much stability. You had 1.5% to 2% inflation in the United States. You had 2 to 2.5% real GDP almost consistently, and then it got a little bit. And then it got really kind of eerily believed in that would continue way back in 2017, which I think the record books will record that was the most low volatility environment, particularly for the S&P 500, where I think the number of days that the VIX was below 10 set an all-time record by a lot. And the narrative of no volatility forever became widely believed. In fact, I was on CNBC in July of 2017, and they said, "What's your highest conviction idea?" And I said that this low volatility environment cannot endure, and volatility will go up fairly substantially. And at that time, the consistency of low volatility had endured for so long that there were a narrative developed that we would never have volatility again. In fact, I said, I think the VIX, which was when I was on CNBC, it was at 9.85. It went by on the crawler. And I said, I think it's going to quickly go above 15. And there was a debate where people said, no, it'll never go above 15 again because the market has structurally changed. And of course, it wasn't terribly wasn't terribly long thereafter that volatility really picked up, and it really became very evident in the fourth quarter of 2018, when suddenly we had a bear market in a very compressed time frame, greater than 20% drop. Then we went back to a new high. Now we've had another huge drop in the early part of 2020, then a big rebound. And I think this volatility that we're having is extremely likely to endure with these moves that are pretty high. And beyond that, I think that we're entering an environment where on a more macro level that we're probably going to have a fat tail event, I think, in the next few years, which means we can't keep going at 1.5% to 2% inflation forever in the context of all of these shocks to the economy with COVID and all of the aftershocks that are still coming about that, and the enormous government stimulus, which is designed, of course, to try to calm things down and take volatility of the market, but it's at such an extreme level with the deficit at 16% of GDP and the likelihood for almost certainty of much more stimulus, we're going to get a lot of volatility. So what's curious is that the United States stock market has once again, it seems like no matter what you throw at it, it outperforms most of the rest of the world. Here this year, many European stocks are down very sharply, but the NASDAQ is up something over 20%. The S&P is positive. The United States has so massively outperformed. Now, what I find curious about that is that the forecasts for U.S. GDP for 2021 on a consensus basis, they've been guessing about 2021 now for a year and a half. the guess for the United States is quite a bit lower than the guess for the world, which I find very odd given the outperformance of the United States stock market. I think the U.S. guessing is 3.9, at least it was earlier this month, 3.7 rather, and the guess for the whole world is 5.2, which suggests that the world ex-U.S. is expected to grow much faster. Now, I don't know why they expect that, but that is the consensus. And yet the United States stock market is by far the strongest. Well, why? How could that be? Well, the simple answer, I think, is the amount of stimulus has just been more extreme in the United States than other places. And especially the money spray, as I call it, the money going out to extra unemployment benefits, which was very significant, gave people more money than they had even when they were employed, before they were furloughed. Over about 3/4 of low wage earners earned more under the money spray unemployed than they did employed. And also our deficit spending and our balance sheet quantitative easing has been pretty enormous. And so it seems that our economy has obviously rebounded very sharply, in particular the housing market, which is really it's just gone on a tear thanks to, I think, all of this money and the fact that interest rates have been kept low and the Fed seems committed to keeping them low. Interest rates are now lower than the growth in wages. The actual interest rate on a mortgage is lower than the growth in things like average hourly earnings, which is a pretty unique phenomenon. That hasn't been the case in decades. And a lot of things suggest that interest rates are artificially low. I like to look at the ratio of the price of copper to the price of gold. It tends to be a signpost for where the 10-year Treasury yield should be. And that ratio has been moving up. That ratio suggests that the 10-year Treasury yield should be at 1.5, but it's at 80 basis points or 85 basis points. We look at other things like cyclical versus defensive equity performance. That also shows that the 10-year Treasury should probably be at 1.5. We look at a lot of things like this. If you look at the 7-year moving average of year-over-year GDP, which is an odd statistic, but it happens to be extremely helpful in determining a central tendency for the 10-year Treasury yield. And that one says the 10-year Treasury yield should be at 3.6. So the yields are really low, and they're being held low, probably somewhat artificially by the Fed. But Jay Powell has said in plain English repeatedly that he does not want negative interest rates, doesn't believe in those. I applaud him for that. For that reason, I think we are not in the danger zone. Negative interest rates would be a real problem. But he also says he is committed to sort of whatever it takes, almost a Macron sort of statement on the quantitative easing, that he doesn't see any limit to the quantitative easing. And that's a good thing, I guess, if you want low yields, because there's nobody else really that has a natural demand for longer term bonds at these levels. Foreigners have been selling U.S. Treasury bonds for quite a while now, and in pretty good size. So there's no buying net from foreigners. Pension plans can't buy Treasury bonds, considering that they need a 7% funding sort of assumption, and the Treasury bonds yield 80 basis points on the 10-year. So who's left to really buy them? Well, it's either retail or the Fed, and it's pretty clear that this year the Fed has pretty much bought all the issuance, or lent the money to buy all the issuance of the Treasury bond market. So that's holding things together. I think, though, that the unevenness of the V-shaped recovery, if you will, it's very uneven, and that's not surprising when you use such a blunt instrument, such as this money spray and all of these PPP programs and all these other things that are kind of unprecedented. They're very ham-fisted, and they have very uneven consequences. So what we've seen is still very big job growth at low-wage jobs, very high unemployment still, a lot of job losses at low-wage jobs. But we've seen full employment recovery at higher-wage jobs. We've also seen a strange phenomenon. This is the first recession in history where personal disposable income went up because of the money spray. If you didn't have those transfer payments of nearly $3 trillion, we would have had a collapse in consumer spending. However, we actually had a big increase in personal disposable income because the government provided all of that money. So the consequence of that has been also very uneven responses to this recovery. Spending is up tremendously for low income people because they spend all the money they get from the government. For higher income people, there's actually been a significant decrease in savings. So the net effect of this has been, to a certain extent, economic unevenness, I think an increase in wealth inequality, and other things that will be echoing through. I also think that in 2021, we're probably going to see some slowdown in employment for what I would call a little bit up the ladder of the economic spectrum, call it middle management. One of the things I think I've learned as a CEO from work at home is you get the opportunity to analyze your business through a completely different perspective. You know, you're so used to being in the office, you have your way of interacting, and now it's all virtual. It's all Zoom meetings and Teams meetings. And what I find is I feel like I've gotten a fresh perspective on who's really working and what they're producing in terms of getting communications on this kind of routine basis. And some of the people who I thought were contributors at a middle management level, they've vanished from sight. I can't even find them. I haven't heard from them in months. And so I sort of say to myself, do I really need these people? And I've taken minor actions, nothing significant, but I've actually furloughed a few people, just saying, I've come to the conclusion that you're just watching other people work. And I also think that one of the consequences of work from home will be migration trends, which are fairly evident already. San Francisco has huge emigration going on. There's an explosion in houses listed for sale in San Francisco. It's triple where it was any of the last 5 years. And here, well, I'm in Buffalo, but in Southern California, I have friends that are trying to get out of Southern California, and they can't get a moving company to give them an appointment because they're too busy. They're too busy leaving California. And people are moving to Boise and Salt Lake City and Nashville and Austin, Texas. And you see incredibly tight supply in those housing markets and really, significant shifts here. And so I think that will be disinflationary for wages as a one variable analysis. Because I think that when people move from San Francisco to Boise, I don't think that they can command the same amount of income. And I think that will be a disinflationary force for that area of the workforce that is not really protected by these government programs, but is not super high income, kind of that middle management area. So I'm thinking that the consequences of the government's response to the COVID situation and the economic collapse is probably going to be negative for the dollar fairly substantially in the longer term. The dollar did weaken. It's now stable, but not strong. It's just stable since August. But I think longer term, there's a high probability that the dollar declines fairly substantially because historically, the deficits, when they grow, and in this case, it's the budget deficits that's dominating, it's extremely highly correlated to a weaker dollar with about a 2-year lead time. And of course, the deficit exploded about 8 months ago. So we should expect the dollar to head lower sometime during 2021 or early 22. And I think that will have an effect on relative performance that doesn't favor the United States as much as it is so powerfully outperformed looking backwards about 10 years. So I'll stop there, Ed, and you can probe in anything you want on what I've said or anything else.
Okay, so Jeffrey, I think this is an election day. So what do you think about that?
It's I don't think there's going to be. Happen? Well, it's strange that election day has turned into election 6 weeks or something, with voting has been underway for quite a long time, and there's still going to be votes trickling in, I'm told, at least in some states for a while. So I'm hoping that we get a clean outcome. I think the chances of not getting a clean outcome, however, are pretty good, because I think both sides have already set themselves up to come up with some, reason to complain if there is anything resembling a close result. Having said that, I still believe, with way less conviction, than I believed in 2016 when I was certain that Trump was going to win because I thought Hillary Clinton was unelectable. This time, I do think Trump is going to win. And I'll tell you why. First of all, there's the shy Trump voters and all that in the polls, which I believe is real, but it's not enough, I think, to turn the tables from the polling results to Trump. But I think the polls are now, like a lot of media broadly, it's not really designed to inform, it's designed to influence. I think it's clear that many news outlets are not designed to inform now, they're designed to influence. And I think the polls, at least some of the mainstream polls, are designed to create appearances of momentum and things like that. So I do think there's something to that, to the so-called shy Trump voters. But I also think that the narrative, if Trump wins, and I'm going to give him a small, greater than 50% chance of that, and not a dominating chance, but I think the narrative will be that he is outperformed in the non-white vote. I think he's doing far better in the African American vote and in the Latino vote than any Republican has done recently. And I also think that a narrative might develop if Trump wins, particularly in the Midwest, that the COVID lockdowns, COVID changes to things like the big universities may actually be material. Think about these huge universities in Wisconsin, University of Wisconsin, Minnesota, Michigan, Ohio State, Miami, Arizona State. These are hundreds of thousands, if you aggregate them, hundreds of thousands, if not million students. These students, a lot of them
and the California school system.
Well, California is just blue as as blue as you can get. You don't have to worry about that one. I'm talking about more of the swing states. I don't think the votes from the students are going to be nearly the count that you have historically, because they get together and they have parties and rallies and rah, and they all go out and vote Democrat. If only 25% of the school is enrolled, you're going to get, I think, a pretty big drop off. I haven't heard anybody in the mainstream media talking about this, but I think if Wisconsin, Minnesota, and Michigan go Trump, I think that'll be determined to be at least a partial reason. And so I glue all this together, and I do lean that Trump will win. Now, it's interesting that when the stock market goes down, like it did last week, a lot of people say, oh, that's the market fears a blue wave. And then the market goes up yesterday and today, and they say, oh, it means that the stock market thinks there's a blue wave. They interpret it both ways. I kind of view that what the market staying firm last week notwithstanding, I think that what the message that I take away is that the market thinks the Senate's going to stay Republican. Because I think what the market would really market doesn't like change when you're in a good place. And I think that a fully blue Congress plus Joe Biden, I don't think the market would like that. I think there would be outrageous amounts of spending. It might be good in the short term. I mean, it might be good short term for increasing valuations. But I don't think his policies are really going to be economically friendly. So I think that the market likes no change. Which, strangely, one last comment on the election. There's a discussion that Trump is some sort of crazy, unpredictable, dangerous person. That's what his opponents like to say. But yet, I think that if you think rationally about this, with Trump, you have a much better idea of what you got when it comes. He gave you tax cuts. He did the tariffs. He did a little bit on the wall. He did significant things in foreign policy, which I don't think he gets enough credit for, particularly in the Middle East. And I don't see rockets coming out of North Korea anymore. So you've got a package there where I think you have data points that suggest that you have some clarity on the future. With Joe Biden, your clarity is really weak. I mean, will he pack the court? What does he think of fracking? I don't know. It depends who he's talking to. And of course, 2/3 of Americans think Joe Biden, if he wins, won't make it through the 4 years, that he would not serve the full 4 years. 2/3 of Americans believe that, which means that you got Kamala Harris in behind that, which you do kind of know what she wants, and it's pretty radically different from where we have been historically in terms of her policies. And so I think it's a lot of uncertainty regarding a Biden win. And so again, I would suggest that the strength of the market leading up to the end of the middle part of October, I think it suggests the probability is higher of a Trump win and the Senate staying Republican than most people believe.
Okay. So, I've been focused a lot, Jeffrey, in the past, I guess, month on the surge in the virus in Europe, which is really grim. And
Yeah.
the lockdowns are occurring, and fatalities are now going up pretty much. And now our cases are going up here. Nothing like in Europe. In Europe, it's like tenfold or 15-fold. Here, it's like 100%.
Yes.
And fatalities are now edging up a little bit. And I worry about all those kids from Ohio State going home for Thanksgiving. And,
Yeah. Yeah.
So what do you make
Well, I
of
think
that
that's a big
whole
risk.
paradigm?
I think another lockdown is a pretty big risk. I mean, they're doing it, as you say, Ed, pretty heavily in Europe. And depending upon, again, the result of the election, I perceive that Joe Biden would be, if he wins, would be more inclined to do a lockdown and
Right.
mass edicts and all
Agree.
this stuff. And I think that would be negative for the economy. I think the virus surging is a pretty big risk because obviously it would kneecap the economy, at least in the short term. And can we really keep going with lockdown and $3 trillion of deficit spending, and then lockdown, and then more trillions of dollars of deficit spending? That doesn't strike me as being an organically healthy economy. It's been very good for speculation. You've probably seen, Ed, that there's been an explosion in retail activity in the U.S. stock market between E-Trade accounts opening up, the volume of small lot trading, these slices that financial firms have been obviously more than happy to accommodate retail investors. The amount of call buying by retail investors has shattered past records. It's a multiple of anything ever seen before, because I think some of that money went into some of this speculation from the government stimulus, which suggests that it could happen again. I think that most people, I wouldn't expect there to be the amount of panic that there was in March and April, even if we had to go to lockdowns and have that, because I think there's a little bit of a Pavlovian thing that's gone on here, that if the market were to offer an opportunity of a 30% sell-off, I think people would probably be less scared, since we had such a robust rebound the last time. We could go into another round of this cycle, but I do think the virus is dangerous. And I also think what's a risk to the market is regulation of big tech. That's been in the air for a while, and it has never happened. But if you divide the S&P 500 into the 490 smaller stocks, which are not small stocks, and then the 10 mega stocks, there's a very big performance difference between the S&P 490 and the S&P 10. The S&P 10, of course, is the FANGs and Microsoft, and they're, of course, just a rocket ship this year. And then you go to the S&P 490, the 490 companies that aren't of that mega cap big tech, and they haven't really done much of anything in nearly 3 years. So it's a very uneven situation between high wage earners and low wage earners, between mega cap stocks and smaller cap stocks, and the breadth isn't very good. So I'm worried certainly that there would be a vulnerability there if we had, as you're correctly pointing out, a European-like surge here. One thing that's curious is one of the criticisms of Trump is, he didn't do like Europe on the coronavirus. Well, not anymore. Not anymore.
Yeah, well, that doesn't get covered very closely. So that brings us, I think, Jeffrey, to the budget, the fiscal stimulus. Because as you put it, virus stimulus, but putting it, with exactly what you think is going to happen. What do you think is going to happen with the fiscal? So you got Trump on one hand, you got Biden on the other.
You're going to get fiscal stimulus. You're going to get fiscal stimulus, I think, for sure. Now, if the Senate's red and the Congress is blue, we might be in the exact same position we're in now, with them all hating each other, and you need a true sense of crisis like you had in March to get them to agree on something. Maybe the election is a reason for them to be doubly reluctant to, do a package last month or something like that. But I think there's going to be stimulus either way. I would bet dollars to donuts that Joe Biden would have more stimulus than Trump. I think Biden would absolutely have more stimulus. That's kind of just the nature. It's just the nature of the political philosophy. But one of the risks that we run here is there's nobody to buy all these bonds other than the Fed. And Jay Powell says, I'm willing to do unlimited quantitative easing, but you wonder at some point, how grotesque the size of the balance sheet might get and how tempted the Fed might be to go yet another step further into the rogue category. The Fed bought corporate bonds and corporate bond ETFs. They're not allowed to do that by their own charter. The Federal Reserve Act of 1913 expressly prohibits that activity, and yet they did it. They thought about buying corporate bonds during the global financial crisis. They declined to do it because they said, we can't do that. That's just too far outside the bounds of the permitted activity from the Federal Reserve Act of 1913. This time they did it. That suggests to me, once you go rogue in such an identifiable way, it means that you've opened the door to going further rogue. And further rogue could be true monetization of all of this debt. We have $157 trillion of unfunded liabilities in the United States. It's 750% of GDP. To pay that off fully without debasing would require 2 generations at least of massive economic contraction. You just can't do it. So maybe the Fed would actually go yet one step more rogue and kind of truly monetize the debt, which would mean declaring their liabilities legal tender. The danger of that is that it would lead to inflation of great significance fairly quickly. I think that's a risk. Now, because of that risk, it's actually a reason why you want to hang on to equities as a core holding for at least, say, a quarter or a third of your portfolio, because at least they would have potential pricing power, and you can always add a zero to the price of a stock. Because I think there's a danger there. You also might want to own other inflation-related assets, and I'm not talking about for the next year. I'm talking about for the next 5 years, because I think that risk isn't imminent. But I believe you need to be more diversified than ever in terms of a barbell strategy. Part of your portfolio should be inflation protection, and the other part should actually be deflation protection, because with all of this debt, as my friend Lacey Hunt at Hoisington points out, it's actually kind of a drag on future growth to have all this debt, and it keeps reducing economic potential unless you turn into a monetization regime, which I like to think won't happen, but it is possible since the Fed can no longer be trusted to stay within the boundaries of its own charter.
So Jeffrey, we talked earlier, you and I talked earlier about vaccine, and in this picture that we're going through with the virus and the fiscal stimulus and the virus fiscal stimulus. So how do you see the virus playing out in 2021? With a vaccine or not a vaccine, and therapeutics or not?
Yeah, I'm not a believer in the silver bullet of a vaccine. We've never had a vaccine for the common cold, which is a coronavirus. We don't have one for the regular flu coronavirus. In fact, the vaccine for the flu, in many years, has a pretty substantial failure rate, where people get vaccinated and they get the flu anyway. There's years when the failure rate is well in excess of 50%. And beyond that, I saw a Gallup poll that asked people if the FDA had an approved, safe vaccine and it was readily available and it was free, would you take it? And 50% say no. So it strikes me that between the failure rate and the lack of universal vaccination, unless it's mandated, which I'd like to believe that wouldn't happen, you would have something like 75% of the population would still be vulnerable, I think, to COVID. So what I'm hopeful for, and I think is already happening, is therapeutics. I think if you could just reduce the severity and certainly the morbidity rates, I think that we could stop being so overwhelmingly concerned. I think broadly, the march toward therapeutics has been ongoing and very ferocious. And I think you have to be optimistic.
Yeah.
I think it's foolish to be pessimistic that you're not going to make continued substantial progress. What we know about COVID now is so much more than we knew 8 months ago. I mean, it's got to be a factor of 5 in terms of what we know.
And you also have testing.
And testing, and the it seems that I think the fatality rates are, well, the signs are encouraging that they're not going to have a rebound of the same level that we had back in April, and that could be because of just the knowledge and therapeutics and understanding the comorbidities and things like that. So I think you have to believe that we've seen the worst. Maybe not in terms of the case count. You could get we're surging in case count, but I just don't believe that the societal effects are likely to be quite so extreme, because we had to attack this very unknown threat with virtually no knowledge. So we went to a pretty big extreme in the way we handled it. You know, building hospitals and ships that were hospital. None of that was really needed or was used. But you have to, you have to round up in terms of your response when you don't really know the parameters, and we do know more about it. So I do think that the societal seismic tremor aspect of it will not repeat close to where we were back in March and April.
So Jeffrey, I have I have a feeling that growth next year, 2021, could be very strong. Let me explain, and then I would be interested in how you see it. So you mentioned the dollar, but you also mentioned latter part of 2021. But to the extent the dollar goes down, that would be a help. Obviously, yes. Rates are very low. The saving rate is very high. Inventories are low. That's a good combination. You told me about your feeling about fiscal stimulus. Added to that, and then it's not clear how the vaccine, how the virus be working. But let's say there's progress on the therapeutics, and it's less of a drag. People can go to football games or museums or whatever. So I could see where growth next year could be 10% if you add all those up.
Well, I think if you have stimulus, that's the case. I think the things that you're referencing make a lot of sense for listed companies and large companies. The one thing that I think will continue to be a drag and may temper that 10% sort of expectation is we've really had problems with small business. There are a lot of small businesses that are shut down that were open at year-end 2019. I haven't seen the most recent data, but the data I have is not very old, and it was something like 24% of the small businesses that were open at year-end are closed. And you can see it in neighborhoods. I just have my own sample when I venture out, but these coffee shops and dry cleaners, and there's a lot of for lease signs. And I think that's the way that you could get your 10%, Ed, would be there'd be an understanding that shutout aspect of the population might get stimulus. Another round of stimulus could lead to your 10% number.
Yeah. So it's sort of related to all this, but a puzzle to me are German bond yields.
Well,
minus 60 basis points.
Yeah. Well,
you're the bond king. So
those are just pegged rates, of course. Japan has been pegging its rates at levels. They're not negative 60, but they've been at 0 on the 10-year and negative on the short rates forever. And what you see, the consequence of that is ever since Japan committed to negative interest rates, their financial stocks have been decimated. It's hard to believe that the financial subsector of the Tokyo stock market over the past 25 years is down cumulatively over 85%. It's hard to believe. It's because of negative interest rates. And then in Europe, they had a nice rebound of their financial sector after the global financial crisis. It looked a lot like the United States, but then they went to negative interest rates. And the United States financial sector into earlier this year made it all the way back to where it was before the global financial crisis. It double topped in terms of its performance, whereas the European financial sector was decimated. It went straight the opposite direction. So the negative interest rates are being pegged by the government and by the ECB, and I don't think they're kind of between a rock and a hard place. They don't know what to do. They somehow think that negative interest rates are a help in the short term, but I think they must understand, and they probably have a growing understanding, that the negative interest rates are decimating their financial institutions, as evidenced by their stock prices. This is why I am so hopeful that Jay Powell is serious when he says he's not going to negative interest rates in the United States, because we actually have a reasonably healthy financial system here. I'm sure it's way healthier than Europe and Japan. And the yield curve has steepened a little bit. Not a lot, but it has steepened, which is modestly positive for our financial system. And I think the path of least resistance seems to be gently higher interest rates at the long end until such time as the Fed steps in and pegs them. I don't know what the level is, but they've used the words yield curve control. I mean, I'm not just conjecturing. I'm taking up their lead. They've said that they would peg interest rates essentially if there was enough upward pressure. But for the time being, our interest rates are pretty attractive for European and Japanese investors. In fact, one of the things that's propelling our corporate bond market is if you buy U.S. corporate bonds and hedge them back into yen, you get about 100 basis point pickup versus buying Japanese corporate bonds. And that's one of the things that has been kind of a tailwind for the corporate bond market, which of course was rescued by the Fed, and I still think has significant solvency risk in parts of it. Parts of the corporate bond market are probably going to have to default. So maybe the prices on parts of the corporate bond market are being artificially held up above their fair value, but certainly some of these foreign inflows have helped also the corporate bond market basically go to no volatility. Junk bonds and investment grade corporate bonds haven't moved in the United States since June. They're just dead sideways.
So Jeffrey, thank you so much.
And thank you, Ed.
It's good to catch up with you. I'm surprised that you're in Buffalo. Have a safe trip back to
that sculpture
California.
behind me is by a Buffalo artist. I've got
Oh, is that right?
Yeah, I support the Buffalo contemporary artists. Some of them, this guy's actually can sell his art. He's got a little bit of an international reputation. But some of the artwork in the first floor here, I'm like the only buyer for some of these artists, and I'm sort of supporting them. They can't sell because it's just local stuff. But it's really enjoyable.
You are supporting a lot of people.
Yeah,
so
yes.
Thanks very much for everything you do, and have
Thank
a good
you,
holidays.
And, all right, good luck with the rest of the year.
Same to you. Goodbye.
All right, bye for now, Ed.